Today, we are diving headfirst into one of the absolute wildest, most unexpected financial stories of the entire year. We're talking about the crazy total roller coaster ride that gold has taken in 2026. This is a story that has caught some of the smartest investors on Wall Street completely off guard. If you think gold is just some stable, boring rock sitting in a vault, well, you are going to be shocked by the sheer volatility we've seen over the last few months. Let's just rewind a few months and look at the tremendous rise. Because just a short while ago, gold seemed absolutely unstoppable. On January 29th, 2026, it essentially achieved this godlike status. It surged to a staggering all-time record high of over $5,300 an ounce. People were completely euphoric. The headlines were basically declaring that gold was the only asset even worth holding. It was this massive, historic peak that had analysts practically falling out of their chairs. But man, the market has a funny way of delivering total whiplash, doesn't it? We go from that massive January peak of 5,300 and fast forward to late June, and suddenly the floor just completely falls out. The price plummets right below the psychologically massive $4,000 mark. We are talking about a brutal 20% crash in just a matter of months. A 20% drop in what is supposedly one of the safest assets on the entire planet. Okay, let's dive into this, because this right here is the billion-dollar question. Why did the ultimate safe haven just lose 20% of its value? How does an asset go from a tremendous historic surge straight into a massive crash when the world, frankly, feels more chaotic than ever? We are going to treat this like a real-time, high-stakes mystery that we need to solve together today. Section 1. The Blueprint, 4 Forces Moving Gold. So to decode this crash, we can't just skim the daily news headlines. We really need to understand the underlying blueprint of the market. There are 4 massive macroeconomic forces that actually move the price of gold. And once you understand these 4 pillars, everything that happened in 2026 is going to start making perfect sense. So the first force is interest rates. Now, as we know, gold is a zero-yield asset. It doesn't pay you a dividend. So when interest rates rise and boring assets like bonds or savings accounts start paying real, attractive cash yields, well, the opportunity cost of holding gold becomes way too steep for a lot of investors. That pushes prices down. Basically, higher interest rates usually mean gold prices fall. Force number 2 is the US dollar. Since gold is globally priced in dollars, a strong greenback makes gold significantly more expensive for foreign buyers. And naturally, that cools down global demand. So a stronger US dollar puts direct, heavy downward pressure on the price of gold. That brings us to the third force, inflation expectations. Traditionally, gold is viewed as the ultimate hedge against inflation, right? But this is entirely driven by forward-looking expectations. If the market believes that inflation is going to cool off and fall in the future, investors start feeling much less urgency to hide their wealth in gold. The need for that insurance policy weakens, which ends up pulling the price down with it. Now, what's really interesting about this slide is our fourth force, geopolitical risk. We're talking about war, global crises, political uncertainty. This is the ultimate wildcard force, and it's the one driver that acts as a pure safe haven trigger. When real fear enters the market, investors panic buy gold. This force is so incredibly powerful that it can push gold prices sky high, even if those other 3 forces we just talked about are actively trying to pull it down. Section 2. The real-world paradox, the current geopolitical crisis. All right, so we have our textbook blueprint, but theories are one thing, real life is a whole different beast. Let's transition into our live case study to see exactly how these 4 forces are actively colliding right now in 2026, creating what I think is one of the most fascinating market paradoxes in modern history. Let's just trace the timeline here. January 2026 is when gold hits that massive peak of 5,300. Then in late February, a major geopolitical event kicks off. The extended conflict between the US and Iran begins. By June 2026, gold actually breaks down below $4,000. And then moving into early July 2026, a fragile ceasefire between the US and Iran unfortunately collapses entirely after fresh airstrikes. Let's zoom in on that February to July window for a second. The conflict involved major disruptions in the Strait of Hormuz, which is an absolutely critical, vital route for global oil shipments. Naturally, a bottleneck like that caused global energy prices to spike dramatically. And you know how this goes. When energy prices spike, the cost of manufacturing and shipping, literally everything else goes up too, which means inflation rises significantly. Now, based on our blueprint, war plus rising inflation should be the absolute perfect recipe to send gold to the moon, right? But it didn't. And this is the grand irony of 2026, the paradox. Instead of pushing gold up as this trusted, safe haven inflation hedge, this exact crisis triggered massive fears that the Federal Reserve would be forced to aggressively hike interest rates to get that new inflation under control. Remember our first force from the blueprint? Higher interest rates hurt gold. So, ironically, the very same geopolitical crisis that theoretically should have made gold go up is the exact mechanism that ultimately pushed it down. To make matters worse, the Federal Reserve wasn't exactly handing out calming tea to the markets. Under the leadership of the new Fed chair, Kevin Warsh, the central bank maintained a highly cautious tone. Multiple Fed officials actually began openly signaling that they were fully willing to implement rate hikes this year, completely dashing hopes for the rate cuts investors were banking on. This hawkish tone sent yields on boring debt assets way up, and it strongly reinforced the value of the US dollar. So gold was literally getting hit from two sides at once, a super strong dollar and the heavy threat of higher rates. Section 3. The long-term market outlook. So, you might be wondering, is it all over for gold? Has the bubble permanently burst? Let's pivot for a second and look at the bigger picture, because it is crucial to understand that what we're seeing right now is a reaction to very immediate short-term market drivers. It doesn't necessarily spell long-term doom for the precious metal. If you look just beneath the surface of the retail panic, you're going to see a very different story playing out at the institutional level. Throughout this entire 20% drawdown, global central banks, specifically China, along with a broadening group of other nations, have just continued consistently buying gold. They are quietly accumulating it. This proves that long-term institutional demand hasn't magically disappeared just because short-term traders are panic selling. Really, short-term price fluctuations and long-term structural trends are two entirely different conversations. And this brilliantly illustrates just how incredibly divided the professional market is right now. On one hand, you have heavyweights like JP Morgan and Goldman Sachs maintaining a highly bullish outlook. They are looking at that steady central bank buying and expecting gold to climb well above its current levels by the end of the year. But then, on the flip side, you have institutions like OCBC holding a very bearish outlook. They're warning that as long as the Fed keeps the threat of rate hikes alive and the dollar stays strong, gold is going to remain under heavy pressure. Section 4. Why this matters to you. So, we've looked at the data, we've looked at the history, and we've untangled the massive geopolitical forces at play. But let's bring this explainer home. Why does this specific 2026 gold crash actually matter for your financial literacy? It matters because this whole situation is a literal masterclass in how global macroeconomic forces dictate asset prices. Gold is just the example we're using today. These exact same four forces affect everything else in your portfolio. And listen, if you want to understand how professional investors don't just survive massive 20% price swings like this, but actually profit from them or protect themselves, you've really got to look at the derivatives market. Professionals use gold futures and options to hedge their bets. We actually did a full breakdown on exactly how that works in our previous explainer on derivatives, so I highly recommend you go check that out to complete the picture on how institutional money actually moves during a crash. So the story of gold in 2026 is truly a massive tug of war between interest rates, the strength of the US dollar, and global fear, all pulling in completely different directions at the exact same time. So I want to pass the question over to you now. Do you think gold is going to shake off the Fed's threats and recover by year-end? Or do you think the weight of the strong US dollar means it's just going to keep falling? Let me know your thoughts down in the comments. If you found this breakdown helpful and want more structured, clear insights into the markets, make sure you hit subscribe. We absolutely love decoding the financial world for you here. Thank you so much for joining me on this explainer, and I will see you in the next one.